Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
Doing great. It's a pleasure to be here.
It's great to have you here, and really fortuitous. We're speaking truly just moments after the September CPI report was released. It displayed hotter than expected inflation data, hotter than expected core inflation, that's ex food and energy. And this is a really problematic report for the Federal Reserve, who's trying to battle inflation. So before we get into the nitty gritty of it all, I want to turn it over to you and ask, what is your big takeaway from this report?
Yeah, well, the consumer inflation print this morning is the story of the day, and I have to be honest with you, it's a very concerning number. First off, just the raw numbers, 8.3% headline consumer inflation, 6.6% core consumer inflation, both of those higher than expected. The most concerning point is that core consumer inflation is rising. It is not rolling over. Now, that's expected, but it's rising at a faster clip than most expected. And that's concerning because that tells us by the end of the year, both core and headline inflation are probably going to converge. But that convergence point has gradually risen from expectations about a 4% to 5% to now 6 to 6.5%. That's important because that tells us that the Fed tightening, the amount of tightening that the Fed has already done and what's already in the pipeline and expected is still probably not enough to bring core inflation down to levels that are considered healthy. That's a problem.
Absolutely. And the Fed has signaled that they care deeply about core inflation, about stickier inflation around things like wages, around things like housing. And clearly, there's still a lot to work out of the system in those types of sectors. I want to turn to what this means for rates and fixed income. So obviously, short-term yields spiking this morning. They're very closely related to what the Fed is doing and what the Fed is indicating they'll do in the near term. Longer-term rates are a bit more of a mixed picture, affected by what the Fed is doing, but also the macroeconomic outlook. The Fed is indicating higher rates, but that also comes with probably heightened recession risk. So from the long end of the curve, say 10-year Treasury and out, what are you seeing and what does this imply for where those yields might head from here?
Yeah, if you're an investor looking at, say, 10-year Treasury yields, you got to balance two forces here. One is the high inflation print and the concept that this means higher yields across the curve because the Fed is going to have to tighten more, and tighten for longer. You have to balance that with the reality here that the U.S. economy is facing a recession in the next 3 to 6 months, and that there's going to be some flight to quality, which means long bond yields are likely to get quite a bit of a bid from other asset classes. So, for example, this morning, as we're talking, U.S. equity markets are down between 2 to 2.5%. Eventually, much of that selling activity is going to find its way back into the U.S. Treasury market, and you're going to see long bond yields begin to dip lower. So the question becomes for investors, when has the Treasury market, particularly 10s, when has it sold off enough so that you're likely to start seeing a stabilization? We expect that point is going to be somewhere around a 4% 10-year Treasury. And today's inflation number maybe only raises that a few basis points, a handful of basis points. But we do think we're getting close to a point where equity market investors are capitulating and there's going to be a flight back into Treasuries. We think we're getting close to that point. Now, I stress this is for the long end of the curve. The front end of the curve could have much further to rise from here.
Yeah, absolutely. I mean, if inflation continues at this pace, the Fed really has no choice but to continue to raise rates higher than have been previously priced in. I mean, they've clearly communicated their intention to fight inflation with all of the tools at their disposal, and I believe that they'll continue to do that. So heading forward, as we look out to year end in 2023, what is one key indicator or a few items that you're watching especially closely to get a better handle on where inflation is headed and what the Fed might do as a result?
Yeah, so the most important data points for each month, we've already had those for the September print. Jobs numbers is always the most important print, in my opinion, particularly average hourly earnings, because that gives you a guide, a bit of a leading indicator as to where core inflation might be heading to. So we just got core consumer inflation today. We got core and headline producer inflation yesterday. We got wages on Friday. All of those data points are indicating to us that we're looking at core inflation printing somewhere around a 6% plus for the remainder of this year and into early next year. Looking ahead to data points As this month progresses, we're going to want to keep an eye on the housing market, particularly things like housing starts. That's a good leading indicator. Supplier delivery times, so manufacturing data points, particularly new orders as well on the manufacturing side. If those start to contract, then what that tells us is that we're looking at a slowdown in output combined with tightening financial and monetary conditions, and that's the definition, almost the definition of a recession. And that certainly tells us, if that happens, that we see a decline in manufacturing output. That tells us that the U.S. economy is sliding towards a recession quite fast.
That's perfect. We always love to end with something to take away, something to watch as we move forward towards year end, and I think that's really great information. Tom, hopefully we'll get to talk again soon. We always really value your insights here, so thank you so much for the time.
Thank you. My pleasure, Ross.